Good evening, everybody. Thank you for your time this evening. So my name's Mark Ellis. I'm the CEO, CIO, and founder of Nutshell Asset Management. And because we're a boutique fund and I created everything in the company and the strategy, I think it's probably worthwhile me discussing a little bit about my background and my journey, because at the end of the day, you're buying me as a PM. This has been a 40-year journey for me. It's been a passion since a little boy, born in Yorkshire in the 80s, badgered my mum to participate in the privatizations and got her to open up a share trading account, subscribed to Penny Share Focus, Penny Share Guide as a teenager, invested all my pocket money, and then decided to create a path into the city so I could do this as a career. I got into LSE in 1992 and read economics. I then went into a graduate training program at NatWest Markets, and there was 50 of us who started, and I was quickly earmarked to be a derivatives trader, which was a hot kind of cash cow for NatWest Markets at the time. And within 3 years, I became voted top 3 global market maker in the derivatives which I was running in the late 90s. I then went on to run a desk at Bear Stearns, derivatives trading desk. And then after 7 years in the city, I kind of had enough, was lucky enough to buy property in the kind of post-Lawson boom and the late 90s, had flats and a house, and went traveling for a year, and then went back to university to study a master's in finance. I got a distinction, and I got my dissertation published in the Journal of Asset Management. And that was really the kind of starting point of this strategy, which I'm going to get into in a minute. The article was called Momentum and the FTSE 350, and I realized it was at the time when factor investing was becoming popular. And I realized that having a crude factor of momentum on the FTSE 350, you could deliver around 17% per annum returns from going long the top decile of momentum when you look back and then hold forward, and going short the bottom decile, the bottom 10%. However, momentum is very dangerous. It would get you into all the kind of tech stocks in December 99, and you would have these horrendous drawdowns. And conversely, you'd be kind of short tech in March 2003 and long defensives as the market turned around. So what I did, I also had over 20 years worth of factors and characteristics of single stocks. And I found if you combine fundamental factors with momentum, the risk-adjusted returns were far superior. And that is the starting point of the strategy. I then went back into the city and was a prop trader at Citibank before the Volcker ruling came out. And then more recently, I was a hedge fund PM at a hedge fund called Symmetry Investments, which is a spin out of Millennium. In 2016, I resigned from Symmetry to focus purely on this strategy, which is my passion. And I spent 3 years creating a model, which now looks at over 35 different factors, which are just characteristics, what we think a company, which are additive to an investment proposition. And in 2019, I used one of my connections to get an introduction to Lord Michael Spencer, the founder of ICAP. And I pitched to him the strategy, the process, and he liked it. And he seeded the strategy with £10 million in a managed account. And we ran the strategy in 2019 and made 35% return for Michael. And in November 19, we decided to then take the next step, launch Nutshell Asset Management, and create an investable product which the retail audience can access, which is a Nutshell Growth Fund. It's a daily dealing UCITS fund on most of the platforms at the moment, over 25, 30 different platforms. And unfortunately, it took around 6 months to set up the structure, the UCITS product. And unfortunately, as you know, in May 2020, we were in the middle of COVID, in lockdown. And COVID caused a couple of challenges. Michael had agreed to seed the strategy, and he was a little bit nervous about putting fresh capital into the market when everyone's working from home. And B, a lot of the factors we look at are these outliers, whether you were a COVID winner or a lockdown winner or lockdown loser, whether you were a Netflix or an airline. So although we launched in May 2020, we were very conservative and had a beta as low as 0.1, 0.2 for the first 6 months, and then we're fully invested later in the year. We then got our full FCA regulation in May 21, and that gave us the ability to fully kind of implement the strategy, including the high proactive trading we do. So unlike a lot of our peers, we trade aggressively. We trade around the positions if they deviate from our target weights. We trade instantly if there's new information. We can go from information to trade within seconds. My background's trading. I have alerts popping up all day long on stocks we cover. If there's anything interesting, we look at it and trade. And we formally recalibrate the whole portfolio from scratch twice a month to ensure we're in the best possible trades, best possible stocks across the globe when you compare like for the best possible price. So it's like a continuous relative value trade. So that's where we are. The performance has been good. We look this week at TrustNet. Our 3-year returns, we're in the top 1.5% of the IA Global Index over the last 3 years. So it's very nice to see. So let me just give you some slides. Do I need to turn this on? Oh, yeah, there you go. Right. So that's what we are. London-based, FCA-regulated Global Equity boutique, seeded by Michael Spencer. The good thing about a boutique manager as well is I'm fully aligned with the product. I've got 95% of my pension in there. I've got all my kids' money in there, and I'm fully invested. I'm fully aligned to work as hard as I can to generate the alpha for my investors. This is a good slide. So this is very similar to my paper, which I published in 2004. And these are just we look at over 35 different factors. We continue to improve in the process, adding new factors. Last year, we added AI winners to the model, and we added insider dealing. But insider dealing when it had a historical track record of producing alpha from that information. So we're continually improving the process. It's very flexible. And these are two examples of two of our most favored factors: return on equity and net profit margins. In terms of geographical spread, from my master's days, I'm very aware that information ratio is proportional to breadth for any given skill. So you want to be as broad as possible if you've got skill or an edge. So we are a global fund. We start bottom up. We start with a universe of about 10,000 stocks, and then to see how calibrated they are to these factors we like. So these charts basically show this green line here is a portfolio of this is in the S&P 500, not the FTSE 350, which I did my original study. And this is all walk forward post my paper. And this green line here is just the top 10% of stocks in the S&P 500 ranked on return on equity and net profit margin versus the index and the lowest decile, the lowest 10%. And what it shows is that over the medium to long run, these quality factors are underappreciated by the market. And by allocating to these factors, we should be able to capture some of this journey. So we diversify over our allocation to over 35 different factors now. I would say around 60% of the allocation is to quality factors, because the quality factors are the ones which are most forgiving in terms of timing and the ones which will come right over the medium to long run. So quality factors, we look at things like profit margins, stability of margins, return on invested capital. We look at some bespoke factors where we look at over 20 years worth of information, and we want as much growth with as little volatility as possible. We look at the second pool is valuation factors. So we look at things like free cash flow yield, PEG ratios, PE ratios. We look at growth factors, historical and forward-looking growth from analysts and from our own analysis. And then finally, we look at more technical, which includes momentum, because we want to be in stocks which have positive momentum. We also look at capital preservation in that pool of factors as well. So we look at things like fundamental robustness over recessionary periods like 08, 09. We look at price action over stressed periods like December 18, when we had that kind of bad sell-off into Christmas Eve, the COVID period. And then more recently, we also look over a 3-year trailing period to work out how stocks performed on the down days versus the up days. And as I said, it's over 35 different factors now. And what we want is as much allocation to those factors which we like for the cheapest possible price. I can probably skip over a few of these slides. So how do we do it? As I said, we've potentially got around 10,000 securities we could invest in. And the initial part of our process, and bear in mind we do this twice a month. And it's a lot of work. It takes like a full day. I get into when we call it a recalibration. So I get into the office around 7:30 in the morning, don't leave till around 9 in the evening. But I'm prepared to do that because it adds extra alpha return to our investors and myself. So we have minimum hurdles for some of the main factors. So we have minimum profit margin, we have minimum return on invested capital, a minimum retention ratio. We don't invest in stories. We invest in companies which have got a decent track record, have won and continue to win, and look like they're going to continue to win. And that quickly gets the universe down from about 10,000 to around 600. And then we push this through a model which I spent several years creating. And I can put any ticker in the model, and it gives me a score roughly between 0 and 100 of how calibrated a particular stock is to the factors we like. From there, we then push model. As you know, models are sometimes flawed. They don't pick everything up. We then get what we call the raw scores out of the model and push them through a more qualitative checklist. So Duncan, my colleague, he does single stock moat analysis. He reads broker research. We look at how robust company moats are, which the model might not pick up. Any kind of potential red flags on the analyst reports in terms of litigation or patent expiry or kind of antitrust. We then look at things like seasonality. We have Sharpe ratios, risk-adjusted returns for every stock for every week of the year, because sometimes certain sectors perform differently over the different weeks of the year. We have a forward-looking IRR calculator, which has a mean reversion of PE and growth metrics, and we have lots of other kind of bespoke, more subjective factors in the checklist. This then gives us what we call is an adjusted score, and we typically then create. Right at the very end, I have what you call a traditional PM type of discretion. So I can adjust the scores by 10%, which typically means, and I can also veto from the portfolio, but we try and keep it consistent every time we do this bi-monthly recalibration. But if I really don't like a company, I can veto it, or if I give it a full negative discretion, it can mean that a number one position can go to mid-portfolio or mid-portfolio out of the portfolio. And likewise, a stock which is just under our universe can be enter the kind of portfolio at mid kind of position weighting. The number one stock is usually around 7.5% to 8%, and it tapers down to around 1%, being a function of the UCITS concentration limits, which the 5-10-40 ruling. So nothing above 10%, anything above 5%, cumulatively can't be more than 40%. We want it to be as concentrated as possible because our analysis has shown that the scores and the positioning in our portfolio really works. And a portfolio of between 5 and 15 stocks is the kind of sweet spot of concentration. So we really want to make it as concentrated as possible, given these liquidity constraints we're in. And that's how we create a portfolio. Because often we find rare, well, we call them rare hidden gems. They're like stocks which many of our peers have missed. Because we start with 10,000, and after the original screening, we can go anywhere. So although we're a quality growth fund, a lot of our peers wouldn't touch a lot of these stocks. For example, Encore Wire. That company there is a copper wire producer. So it's an industrial company. And my quality growth peers wouldn't go anywhere near the industrial sector. And the reason we got that is because, I mean, it's a fair enough company. It's one site, phone to door in 24 hours. It provides the cloud infrastructure with copper wiring. But the main reason we got that is average quality, but we got it on a PE multiple of 3, which was then the free cash flow yield. The valuation factors were so compelling, which made it kind of push its way into our portfolio. And last year it got taken out by an Italian company on a multiple of 15. So likewise, Coca-Cola Consolidated, we just recently got out of that. When we bought that, didn't have one analyst covering it. That's a bottler in the US. So we often find these stocks which are completely unique to our portfolio. Atos Software, we just bought that recently. That's a small German software company. That's actually really helping us out this month in this current drawdown. Today that was up 10%, 9 or 10% month to date, even with this kind of correction we're having at the moment. And as I said, another offering or unique differentiator about our fund, based on my background, is we trade around the positions. We don't buy into this turnover is bad. We've got a lot of analysis that we're really high turnover, and we do it systematically with a purpose. And most of our peers, I think they don't like it or don't do it because they do all their work finding these rare, exceptional companies, and they have this dilemma. If they sell, what do they do with the proceeds, and when do they get back in again? But because we're constantly having this relative value trade, we know if we sell, we know exactly where we're going to put the money because we know what stock has kind of moved up the rankings to take that position. So typically, I come into the office early in the morning for the UK Open. I run through all the portfolio and see if any of their scores have changed, any news. The model's live. I can go from earnings information to trade within seconds. Q1 last year, Novo Nordisk had its earnings, and the brokers were pretty indifferent about it. I put the ticker in the model, and the score jumped, and I knew I had to buy some at the next recalibration, so I discretionary started to buy intraday, and then throughout the day, more positive analysis came from the brokers, and it moved back up, and then went on to make new highs. But why I'm saying is that we can go from information to trade within seconds rather than wait for broker research, read research, have investor committees, take weeks to put the position on. We're very nimble, so we think that's a really good advantage as well. And my background, as I said, I've got alerts on all our stocks when they move intraday. So often we end up with this kind of trading these U's. Rightmove's a very good stock. Is that Rightmove? Yeah. To do this. So we do trade a lot, and we trade intraday, and we formally create the portfolio twice a month from scratch. Right. Returns. So I'll spend a bit of color on a bit of time on this. So this was managed account money. This was when we were underinvested in the COVID period, but then walk forward, the returns have been very good and very strong. So 21 for a growth fund, 25.4%. 23, 26.5%, and last year 26.7%. So significantly better than our peers and our benchmark. The drawdown, the loss in the bear market of 22 is a bit disappointing, but the reason for that was we were probably neck and neck with one of our leading competitors, who I can imagine a lot of you have got investment in. Neck and neck with him until Q4 22. And that's when we pivoted into mega cap tech. The model and the process was identified that large cap tech in the US was really cheap in Q3 in that bear market. So our tech exposure went up to 40%. And unfortunately, that didn't really bottom until December. So we were neck and neck with one of our peers who's a lot more defensive. He has tobacco and some of these kind of defensive positions up until that period. But then we got it all back in 23 when those tech names did really well. And another good thing from my trading back days, this kind of risk reward looks pretty compelling as well. If you compare that to other growth funds, typically what happens, they might achieve this, but then this would be significantly more than these profitable years here. This kind of reward to risk barbell looks attractive relative to our peers, which is nice to see. A couple of years ago, we had an intern working with us, and one of the jobs we gave him was to look at some of our peers, our kind of similar funds in the global quality growth space, and just run a heat map of all the kind of factors. And we've done this a few times. This is a bit dated, but it's generally the same story. If you look, and this is a top 10, so these are a little bit richer, these PE multiples. Our PE is generally around the S&P, just slightly above the S&P, around 25, 26 as a full portfolio historically. So this is just showing that by doing this relative value process, we're ending up in companies, we're really nicely exposed to these quality factors which we want. So we've got the highest return on equity, highest profit margin, highest return on invested capital out of all these funds on these listed top 10s, and the highest estimated long-term growth. And then in terms of valuation, the lowest price to earnings, second lowest 2024 price to earnings, second highest free cash flow yield. So as I said, it's one continuous relative value trade where we get the exposure to these rare, exceptional companies at the cheapest possible price. And in terms of these slides are a little bit dated. So it just shows you, these are kind of factor exposures of different groupings. So we're usually in really mega cap, really liquid stocks. So our average market cap is generally between $400 and $600 billion. We do the majority of our trading in the closing auction, especially when we recalibrate, all the trades go in the closing auction. We get mid-market price. We've got really, really cheap trading deals with our brokers. The intraday, we've just had some, we call it TCA analysis, trading cost analysis from one of our brokers. And our intraday trading, we actually get positive slippage from arrival price. Because of my background's trading, I've created algos which we enable us to transact intraday, and their analysis shows that from arrival price, because we fade the flows coming into the market, we generally get positive slippage to where the trade goes in. So again, not a believer in that trading is costly or is a bad thing to do. So as well as size, high credit strengths, we've got a lot of exposure to the profitability factor. So in risk-off events like COVID, you generally get a flight to quality. All the stocks with high profitability do really well. The kind of Visas, the Microsofts, those kind of names. High quality, as we discussed, and profitability. And then this made it in. This was a late addition. So this is, as I said, our way of running the fund is very different to our peers. It's based on my background, what I think works, and my 40-year journey, really. So, as I said, typical PMs rely on either internal or analyst reports. These reports, and we've already analyst reports, they kind of, in my mind, change like the wind. The analyst changes like the wind. I mean, they don't seem to have much credibility in my eyes. We do all our own internal research, and we compare like for like across the globe every time we do this kind of analysis. Timing, when we sell, we know exactly what to buy because we know what the next best stock in our universe is. Breadth, as I said, for a given edge, you want to be global. You want to express that edge on as much as possible. And trading, as I said, I've got 25 years of market making, prop trading, hedge fund experience. So a lot of this is quite important in the development of the fund and the strategy. So in my mind, you're getting a very kind of hedge fund type product for a retail type cost. There's a lot of work in this. There's a lot of algos. There's a really robust, decent process. And we're only charging you as low as 75 basis points with no performance fee. And as I said, we're reactive. We can deal with new information instantly. And also, the process is flexible. So if new trends appear, hopefully we won't be the kind of candlestick fund manager of the last decade, like some of our peers seem to have kind of dissipate away in terms of performance. We'll continue improving the process. If new themes or new ideas come online, we can research those and add them to the process. And this is the kind of the good bit, which shows it's kind of working. So this is from TrustNet this week, the 11th of March 25. That little drawdown, unfortunately, might be a little bit steeper, a little bit longer after the last couple of days. But even still, over 3 years, we're position number 6 out of 483 stocks. And bear in mind, that index has got survivorship bias, where over the last 3 years, I don't know, maybe 20 funds or 50 funds or whatever probably dropped out of there. So we've returned 24.4%, 54%, which is more or less more than double the index over the last 3 years. And we've recently been awarded Morningstar 5-star, and we've got an elite radar rating from Fund Caliber. Platform availability. As you can see, we're kind of present on most of the leading platforms. Our sales guys are kind of keep pushing to get us on as many platforms as possible. Interestingly enough, AJ Bell was the first platform we got on. Michael Spencer had a bit of a relationship with Andy Bell and got us on there pretty quickly. And that's it, really. And I'm open for any questions.
Thank you very much. Thank you. All right then. Hands up. Okay. Please. Sorry. We'll come to you next. Okay. Thank you.
Thank you for a very interesting presentation. You described in great detail about your buying and the factors that you use, but you haven't said very much about you recalibrate twice a month. You haven't said very much about the selling. What initiates your selling?
The whole process itself, the buying and selling is embedded. So generally, every time I recalibrate, what we call is the adjusted scores move up or down. So I create a new portfolio, and say Microsoft and yesterday's portfolio might be 7% on the new portfolio. When I rank everything after I've made my PM adjustments, the whole idea of the process is to make the kind of tight focus set as PM proof as possible. Like Warren Buffett likes companies which are CEO proof. We want to be in these rare exceptional companies and make them as PM proof as possible. And the end of the process is what we call the adjusted scores, and that ranking gives me a new portfolio. So that indirectly tells me what to sell. As Microsoft might go from 8% down to 5%. And I don't know, NVIDIA might go from 3% to 5%, whatever it is. And our new rankings automatically tell us what to sell.
And that's done twice a month?
Twice a month, yeah.
Okay, thank you.
Question here then, please. Thank you.
Thanks for the presentation. It's very interesting, the trading mentality and so on. Just wondering, do you actually conduct any stress testing when you do the calibration? And if that's the case, what kind of scenarios that you identify as a kind of most worrying combination of factors? Liquidity, I believe. One is liquidity.
Sorry?
Liquidity could be one of them. I think.
No, Duncan, my colleague, has the traditional kind of scenario and liquidity analysis, which we have to provide to our kind of fund providers. As I said, our average market cap is 4 to 600 billion, and we've had instances where we've had to liquidate a significant amount of the portfolio in one day. We could possibly, my view is we could liquidate the entire portfolio in one day at its current size, which is around $90 million pounds AUM. So it's not a liquidity issue. As I said, at a single stock, this is all bottom up, at a single stock level, we know how stocks perform on risk-off events like COVID, like December 18, and we know how they perform on down days. We look at a thing called minus beta, which is if you just regress the down days, what that beta is relative to the positive beta. So because we're highly exposed to profitability factor, which is one of our highest kind of weighting, when you do get these risk-off events, we perform really well relative to the index and our peers. Another good risk-off characteristic of the portfolio is it's a UK-based fund investing a significant amount of money in the US, so it's unhedged. So it's typically 60 to 70% US. So when you get a kind of COVID-type event, you get a flight to quality in the currency, in the US dollar as well. So in 2020, cable probably went from, I don't know, I'm just guessing, maybe 125 to 105. And you get that as protection because we own those US assets. So our drawdown over the COVID period was probably about half the index around that because of the high exposure to profitability factor and the kind of unhedged dollar assets we own.
So do you actually hedge the currency?
No,
not at all.
Yeah.
Please, yep.
You obviously put a lot of time and effort into this, as you outlined very eloquently. It gives me a slight concern about key person risk. Yeah. What's your blood pressure?
It's a really good question, and it's one we get asked quite a lot. So yeah, like every fund in my area, there's a lot of key man risks, whether that's Terry Smith or whoever.
I think Terry Smith's laid it off to a fair degree, to be fair. One could make that comment about Stephen Yu.
Yeah, or Stephen Yu or whoever. But look, Michael Spencer now owns 40% of Nutshell Asset Management, so it's a concern for him as well. And we're taking steps. Duncan, my colleague, is ex-Morgan Stanley. He's a generalist PM. He's been a generalist PM for Allianz. He helps me out in the process. He could take over the reins tomorrow. On top of that, we're growing the team rapidly. We used to be quite small up until recently when Michael injected some capital into the company. And we've just hired a head of research, a couple of quants, and the team has more than doubled and will probably triple this year. So, as well as the obvious key man risk insurance, which we will take out, Duncan would take over the reins as co-PM. Yeah.
A question behind.
Thank you.
Yeah.
Very interesting comment you make. A very, very interesting comment. We know exactly when to trim. Very few fund managers would say they know when the market's going to go up and down, if I may continue.
Yeah.
But with the vagaries of geopolitics, would you do a Warren Buffett and liquidate tomorrow if you knew that actually you could buy the whole portfolio again for a much lower price?
Yeah. I mean, when I say we know when to trim, it's relative to the things we can buy. Obviously, I haven't got a kind of forward-looking time machine. But yeah, I mean, look, we're a fully invested fund, and our mandate says we have to be full, kind of, I think 90% invested. I think we can have 10% cash. But yeah, we don't want to time the macro environment and what Trump's going to tweet. We want to be fully invested, and if our investors want to have those views, that they can express it with their allocation. Yeah.
And we are a bit over time. We have one more, and then we'll have to catch you over a glass of wine afterwards.
I enjoyed your presentation. I don't normally invest in ETFs, and I think this is an ETF you're talking about.
It's a UCITS fund.
Yeah, it's not an investment trust. If I'm buying into you, what is the management costs that the fund is carrying? And you mentioned 35 basis points, but there must be other costs as well.
Yeah.
And the other factor is what's the margin between buying and selling your stock?
Well, let me start with a really good question. There is no bid-offer spread. You get the closing NAV, which is all kind of mid-market closing prices of all the stocks we own. In terms of what we've been going for a few years now, and we used to get kind of battered off with the usual too small, too expensive, no track record. So at 90 million, we're probably just getting away from that too small. We've now got the track record, but that track record there, the 3 years, as it was with quite a bad headwind in terms of costs. Our OCF was around 1.6% for most of that, so probably around, I don't know, 85 basis points higher than our peers like Blue Whale or Fundsmith. But what recently happened, we've recently capped our expenses at 10 basis points, and we cut our AMC. So now you can get our fund for as low as 85 basis points all in. So 75 basis points, AMC, and 10 basis point cap on the total expenses. So a mid-market on all the assets we own when you get your NAV.
Lovely, Mark. Thank you very much indeed. Thank you for the presentation.